And perhaps more importantly, on the desk is our great friend, Frances Horodelski. There's a lot. I feel like I've been running a bit of a marathon. It's earnings season. There's a lot going on in macro. How are you thinking about things these days?
Good morning.
August. Even though it's August, I'm still forcing you to think about it.
It is August, and August is kind of a weird month, generally speaking. I found the PPI number this morning interesting because in June, we had a big surprise to the downside in PPI, and that set us up for that big July rally. Now we're getting this, what was it, 0.1% above expectations? But that's setting us up for this, I like to call it this chop.
I mentioned, and I didn't do it very well, but the University of Michigan inflation expectations. So you have CPI yesterday, PPI today, but inflation expectations cooling for both 1 year and for the 5 and 10-year outlook. If the Fed is more worried about expectations, this is moving in the right direction.
So you taught me something once about soft data versus hard data. And isn't this the greatest of soft data? So that I'm not exactly sure when those surveys were taken.
For August preliminary.
But it was,
fresh.
It was probably a couple of weeks ago when everybody's been talking about inflation rolling over. The headlines have been talking about that. We had the whole discussion of the pause. So these sentiment numbers reflect what's going on around people. So I'm not that surprised that we saw those expectations come down.
Although, if only it was that easy, right? If we let's just tell everyone inflation's going down, we'll believe it.
Ultimately, but it's not going to show up in contract negotiations, which is probably one of the biggest headwinds for inflation expectations going forward. We have the UAW next month. We've had UPS. So those pressures and headwinds will start to show up in mentality.
That's becoming everybody's favorite stat, is how much a UPS truck driver makes. $170,000 US for long haul driving.
It's a tough job.
It is a tough job.
And you didn't have air until recently.
I know. I saw that part of the billions that they're going to be spending on new things is to put air conditioning in the trucks. Like, we're in this heat wave.
It's a tough job. So they should be getting, I'm not going to opine on how much they should or should not make. The more important aspect of all of that is the pressure, upward pressure on inflation projections in the U.S. But the big thing in the U.S. is owner equivalent rent. We've talked about that before. It's rolling over. It's a lagging indicator within the whole concept of the inflation calculations. So that's going to be a tailwind, actually, for inflation going forward. None of that matters on a day-to-day basis in terms of what we're going on in the equity markets.
Okay, well, let's find out what does. Let's bring in Tom Essaye. He's president of Sevens Report Research. Tom, thank you so much for being with us on the desk. You kind of heard us kind of go through some of the data. Ultimately, it speaks to this issue that the markets have rallied, been resilient broadly. The soft landing has basically been canceled. The recession has been canceled. How are you thinking about that?
Good morning. Thank you very much for having me on. I mean, look, right now, it's a pretty good setup for stocks. I realize that markets have come off the highs last few weeks, but that's more of a function of just sort of stretched valuations than it was anything bad happening. We have an environment, we call them the 3 pillars of the rally, right? It's the no landing, there won't be a recession is pillar 1, ongoing disinflation is pillar 2, and then the Fed being basically done with rate hikes is pillar 3. As long as those are intact, then the outlook for stocks is pretty positive. The issue we're going to run into, and we're starting to run into it now, is what happens next, right? What's the next positive thing? And it's unclear at this point. So I think that's why the market sort of stalled here a bit.
Do we have to tell the bond market of those 3 pillars you discussed? Because the bond market seems to be where people are focused right now. We have the 10-year back to 4.11, give or take. So that's one of the headwinds for that valuation you talk about. So we're just taking a look at the 10-year bond yield right now. Put that into the context of everything else you see.
Exactly. So the rise in yields is becoming a sort of unexpected headwind on stocks, right? It's not substantial yet. It could become so. What we're trying to figure out is, why are long-dated yields rising? Are they rising because the market thinks there'll be better economic growth, stickier inflation? Are people worried about the U.S. now from after the Fitch downgrade? Does it have to do with the Bank of Japan letting their rates rise? This is something people did not anticipate, right? And as always in the market, investors want calm. It's okay if the Treasury yield kind of drifts higher. The problem is that it has accelerated higher recently. If that continues, it will be an unexpected headwind on the equity market, as well as obviously bonds falling.
Mainly because the headwind will show up in tech, and tech is already the worst performing sector for the month of August. It's the worst performing sector over the past month. But it hasn't been, everything that has come down. You've seen this rotation into other areas, namely energy, also healthcare. Are you a believer in that kind of rotation?
Yeah, I think for the time being, yes. I think that you can still see sort of more cyclically oriented sectors outperform in the near term. And by the near term, I mean the next couple of months. The million-dollar question, or trillion-dollar question, I should say, is what happens as we enter into the fourth quarter with economic growth? Because the market, really the sentiment shift has been amazing this year, hasn't it? In January, everybody was convinced we were heading for a recession and things were going to fall apart. Now, nobody believes that the recession will occur. And I'm saying nobody, but the consensus has become much more positive. The problem with that is that we no longer have low expectations to help support positive surprises. Now we have high expectations where positive surprises are sort of assumed. And I think we run into an issue of what gets this market 10, 15% higher by year end.
So with that capitulation to what seemed like everybody throwing in the towel on the recession forecast, it seemed like we had that whole run of everybody throwing out that playbook. If, in fact, the expectations for something harder in terms of a landing rise, where do you want to be? Do you want to be in healthcare, for example, which has underperformed and is cheap?
Yes, you absolutely do. So if we get all of a sudden worries of a hard landing resurfacing, then what's lagged year to date will begin to outperform, right? So your healthcare is number one, utilities, consumer staples, those are where your classic recession plays, right? And if you look at the two previous real bear markets we've had over the past 20 years, in the mid-2000s and early 2000s, it's those sectors that outperform. Now, I'm not saying that's definitely going to happen, but that is where you want to go. And you're absolutely right. In a market where there isn't much cheap anymore, those sectors do have some value to them.
What if we get a stimulus surprise out of China? Today we got another data point that confirms that the slowdown definitely is slow. In China, the central bank meets next week. Could we get a stimulus surprise? Especially they've got deflation to deal with. They certainly could afford to start stimulating.
Yeah, the sooner the better. I think the market would say it's sort of different this time a bit with the Chinese, isn't it? Normally, they just sort of open this stimulus bazooka kind of almost willy-nilly. This time they're being much more guarded, and they seem to be launching a campaign to convince the market they are going to do stimulus via their rhetoric, yet they don't seem to be too keen on actually doing the stimulus. And I think that's something the market is wrestling with. I think it has to do with some of their internal finances. I think it has to do with the fact that the Chinese economy is changing, right? It's not just all export-based. It's more of a consumer-oriented economy now. And that's harder to stimulate than when you just have to sort of export more stuff. And the sooner the better, though, from the market. China is a worry. There's no question about it.
Tom, thanks so much for joining us with that perspective.